All right, hey guys, this is the third video in our five-part series, and it deals with timing differences between when economic value is created or consumed and cash flows. So next, what we want to do is we want to move to expenses, and specifically accrued expenses. This is the case when value is consumed before we've made the payment. So you may be able to relate to the following. Have you ever used something but not paid for it yet? That cost is real even if no money has left your account. So far, we've looked at income, but you've earned value before collecting cash with income. And when you've collected cash before earning it, we've looked at those two different scenarios. Now we're moving to the other side, expenses. Because just like income, expenses don't always line up with when you pay. Sometimes economic reality happens first, and the payment happens later. Let's look at our first example to make this more clear. Let's look at credit card purchases. Think about your credit card. You buy groceries today, but you don't pay the bill until later. So what's happening in terms of economic reality? You've already consumed the value, you've eaten the groceries, but what have you paid for? Nothing. You have not yet paid your credit card bill, and so you've consumed something before you've paid for it. That consumed value is called specifically an expense. And notice here that the word expense specifically refers to consumed value and not cash outflow. If you have a cash outflow, it can be an expense, but it may not be. Okay, it could be an investment. An expense is simply value you've used up. And because you haven't paid yet, you now have an obligation. That's a liability, something you owe. Example number 2 may help further deepen your understanding. Utilities. Now think about your electricity. You've been using power all month, okay? But the bill only shows up later. The economic reality is that you've already used the electricity, but you have not paid for the electricity yet. The cost exists before the payment. And so your utilities bill would be a utilities bill outstanding, and that would be a liability that you need to pay. Thirdly, we have property taxes. They build up over time, but you might only pay them once or twice a year. So even if you haven't paid yet, you've already incurred part of that cost. The obligation grows before the payment happens. So this situation where you've consumed value but haven't paid for it yet is called an accrued expense. Okay, the expense has accrued. And formally, accrued expenses are value consumed before the payment is made. And every time this happens, expenses increase and liabilities increase. So if you've used something but haven't paid for it yet, you don't just have a future payment, you already have a cost and a liability. So now we've seen 3 patterns. Value is created before collected, an asset. Value, or rather cash, is collected before the economic value is given. That is a liability. Value is consumed before it's been paid, and that creates a liability. So next, we'll look at the opposite side of this. What happens when you pay first and consume the value later. So once you understand all of these, you'll see why just tracking what you collect and pay doesn't tell the full economic story. And that's why this is another necessary ingredient, another necessary concept before we get into actually building our personal income statement, which tells us about the economic value created and consumed during a period of time. If this was helpful, make sure you click subscribe so you get notified upon new creation that hopefully can help you manage your finances better.